see. There we go. Okay, we can share. Okay, good. All right. So I'm going to share with you.
I think you should just say share screen.
Oh. So what do I do? Huh? What's this now?
That's normal.
Is it normal?
Yeah.
Why is it normal?
Because that's your screen.
But it's why it's doing that?
Because that's what happens. It sees your screen and then it's displaying the screen like it's in a constant loop.
So what to do?
Well, this is your screen now. This is what it will see.
Okay. All right. So I'm going to just go through this with you. So I started this in, like, I will say about 2000. So in the year 2000 was the year I started to read about 2001. I started to read about Rich Dad Poor Dad, and then Warren Buffett's The Warren Buffett Way. And then afterwards, this kind of investment research and portfolio construction is based on the learning from the book, The Warren Buffett Way. Okay, so I will start with the process, so you understand the process. Okay, let me just change it to like that. Okay, so the process is to construct a portfolio that is, number one, likely to provide an annualized total return in excess of 20% over a 3-year period. So every year, the return will generate more than 20%, but it's over a 3-year period view. Okay. Second one is requires no trading. 3 is focused on, has a few but not many companies. So it's between 8 to 12 companies in 5 to 8 sectors. So when we talk about diversification, I think that Warren Buffett, he talks about there's need for diversification, but you mustn't diversify too much. It's actually a focused strategy. So, but it's important to diversify across certain sectors and the various companies. So in terms of the process, in terms of stock selection, number one is consider the local and the global economic environment and the trends in various industries. So it changes all the time, and we need to be aware of the environment. Number 2 is to list companies for consideration. And these are my criteria. The first one is companies with low PE and reasonable prospects, or companies with reasonable PE and excellent prospects. Okay, and then so the second one is cyclical companies with reasonable PE and excellent recovery prospects are also considered. So we can have a company which may not be the best company, but it's a cyclical company with an economy, but it's reasonable PE, and we know that going forward there's excellent recovery prospects. Then that will be considered. There should be 30 to 40 of such companies that we consider. Then 2.2, remove companies that I know nothing about or I find difficult to understand. So Warren Buffett in that book talked about your circle of competence or your knowledge. So you know your stuff, and you focus on these instead of like trying to pretend you know everything. And that's why Warren Buffett, he didn't invest in technology company until like more recently, like over the last 10 years. Then 2.3 is to put each into one of the 6 types as per Peter Lynch book. So Peter Lynch in his book he talks about the 6 types of companies. So that's what I would do. And on the right side is the source of information. This is quite a few years ago. So Financial Mail, Internet, Money Web, CNN Money, Economist. Obviously now probably like Bloomberg and other stuff. Then yeah, so that's a source. And I was also using PSG Online, but you can certainly use Standard Bank Securities or any stockbrokers for research that information. Then 3 is the filling JSE share prices as at 31st December in candidates sheet. 4 is complete sections on business prospects, profit margin, management, market cap, etc. And then number 5 is tally the score and rank in terms of the total score. Number 6 is assess personal, add personal assessment and comments. 7 is decide on the companies to be included in the portfolio. And it should have 1/3 large cap, 1/3 mid cap, and 1/3 small cap. But again, if you look at this kind of a construction, it also depends on what you're looking at. Are you looking at just local company? Because local company, you can have a local large cap, but on the world stage, it will actually be like kind of a small cap or even a micro cap. So it depends on how you evaluate it. Number 8 is weighting. Give higher weighting greater than 10% to shares analyzed with good short-term prospects and the trading at a discount. And give lower weighting, less than 10% to shares not valued using the valuation method, poor short-term prospects, and or trading at fair value or at a premium. Okay, then here is the tracking. So do it in August, September of every year. And number 2 is update information on dividends, year and share price on the tracking sheet. And then number 3 is tracking the portfolio for a period of 5 years. Number 4, consider and note down reasons for deviating from original expectations. So there will be reasons that only manifest afterwards why maybe certain company didn't perform as expected initially. And then number 5 is note down lessons learned and use them to further improve future stock selection. So the methodology was based on Warren Buffett's that book, The Warren Buffett Way, and Philip Fisher, and my own investment file. Okay, so that's the process. So I want to show you the previous portfolios that I put together. I put together these from 2002. And this is the track record just to show you kind of year by year. So this is 2002, the portfolio, and then 2003 and 2004. So in 2002, I had 8 shares in the portfolio. And you could see at that time, some shares had quite high weighting, like 20%, and then 2003, and then that the shares that's highlighted in kind of gray are shares that have appeared twice or more. And you could see at that time, 2004, Steinhoff actually was in my portfolio. Okay, that's in the early years. And then that's how it transpired over the years. Okay, from 2002 and all the way to 2014, 2015, I stopped creating, or I didn't have time to do such exercise anymore. But you could see that this is the portfolio. Yeah, so every year is different because at the beginning of the year I then revisit and then look at if I were to start at that time, what would be my portfolio? And then if you see, this is the return over the years. So just to show you, in 2002, the return was 14.6%, and 2003 was 30.2, 2004 was 62.6, 2005 is 57.8%. 2008 was because of the financial crisis, GFC, and then it was down, and then how it compared with the JSE, the overall index. Okay, and then it shows how my portfolio has outperformed the JSE over the years or underperformed. So in 1 year it underperformed, but in other years, 2006 also underperformed. In other years, some years outperformed significantly. And then this is just show you if you started at the same and using the annual return compared to JSE, and from 2001 to 2014, how my portfolio would have compared against the JSE over those periods. Okay.
Is this actually realized?
No, it's if you can say it's a simulation. Yeah, but it's a kind of a model portfolio I put in every year. So it was not like I actually put it into the actual share portfolio. But if you look at 2013, there were some international shares like AIG, Apple, Barclays.
What are you showing me? Is this the actual?
That's my portfolio.
Historic portfolio.
That's so I use the methodology to choose the portfolio of stocks, and I track the performance over the years. So 2002, that will be the performance of that portfolio that you saw there. Okay, 2003 is that portfolio, etc. You follow?
Mm-hmm.
Okay, so that's how it's changed. And if you look at even like many years ago, I already had paid attention to a company like Green Dot. Yeah, and afterwards it did go through the split and that, but still, I think right now it's still a interesting or good company. And in 2012, I included like HTC from Taiwan. I don't think it existed anymore. Yeah, but at that time was doing well. And even South Ocean, I knew Southern many years ago. At that time, it was a small part of it. But in 2014, that's a portfolio. So it's mainly becoming more of a international companies. And then so here is 2015. So what I do, I follow the process and say, okay, so first follow my process. The first thing is to look at the environment. So I look at the global economy, promising sign of growth, and the US and the emerging markets and the currencies, and looking at the local economy and the politics. And then also look at the industries with good prospects. So I was put down there like retailers, industrial companies, resources, and then to include in the portfolio. So based on this kind of I filter down to say what I want to include in the portfolio. So I look at the large multinationals, Apple and Google, and then look at the large foreign companies that will have worldwide markets, and solid companies with share price that have underperformed and present entry at the low price. Okay, tells me I need to charge. Just let me get my. Okay. Yeah. Okay. So that's first looking at the outer environment, and from there, then I selected the candidates, and so there's a list of quite a few. I think it's more than 40. Yeah, and that's a kind of a spreadsheet I built. So the spreadsheet number one is the company, and then the short code, the sector. So I want to diversify across sectors, and then the country, and then category. So category here is using Peter Lynch method. It says that, or my method is that category one is a company with low P, and excellent prospects. Category 2 is company with reasonable PE and excellent prospects, and then company with low PE and the reasonable prospect, and company with reasonable PE and excellent prospects. Okay, and then here is the type. So type is looking at Peter Lynch method to say, is a cyclical, is a fast grower, is a stalwart company. Okay, and then here is the reason to say it's such a case. So, for example, Pinnacle is a computer hardware company in South Africa. I don't know whether it's still listed. I don't think so. But at that time, it seems to be doing well, growing its revenue and all that. So it's technology, and easy to understand. It's computer hardware, consistent operating profits, prospects, its profits going forward, and also then the prospects reason. At that time, it's noted as recovery. So there's notes to say it's easy to understand. Yes, it's 1. If it's not, then it's 0. Okay, and then the consistent operating history. So that's 1 is consistent, 0 is a volatile result. And then the prospects, 1 is a growth industry or able to grow market share profitably, and the 0 is not the above. Okay, and then the prospect reason. And then we look at, so looking at the Warren Buffett way is first to talk about the industry thing, then talk about the prospects, then talk about the management, how it's, I think as an outsider, it's generally difficult to understand the management. Okay. But I think from the kind of the market news and also that from the financial reporting, hopefully we have a glance about management and its actions. So I put here 3 is excellent management team with depth and track record. 2 is excellent management team, but not necessary with depth or average management team. And 1 is unknown or poor management team, self-interest, not transparent. Okay. Again, for outside shareholders, it's always going to be difficult to understand fully. And then management reason that I say is 2 or 3, and then directors' dealings. Director dealing give an insight in terms of how the directors think about the company, whether they think company is going to do well and they buy more shares, or they're selling shares because they think it's highly valued, or they think they probably they think there's a problem, or they know there's a problem with the company and they rather just sell the shares while the price is still good. So directors' dealings can be an indication of what they think about the company. Then here is the recommended. So whether okay, so I look at the fund managers at that time, Alan Gray, Tim Alsop, John Bickard, or successful manager, and whether they hold a company shares. Again, it's normally it's they will only disclose the top 10 holdings. Maybe we can look at a quarterly report to have a better understanding of their holdings. But yeah, so if it's held by fund managers, then I'll put a 1. If it's not held by fund manager, then it's a 0. Or if they don't recommend, they say why they don't hold such shares, then it's a 0. So here you can see like Pinnacle, it's got a very little institutional holding. Then ROE is return on equity. Then there's RE score. So generally, the higher the RE, consistent RE is good. Okay. Then it's headline earnings per share. So it's just information that I put it into here. Then cash flow to see does it have a positive cash flows. Okay, does it generate cash flow and management, return money to a shareholder, and then operating profit margin. Then the next one is $1 promise. So the book, the Warren Buffett share way, says that the $1 promise premise is that if the directors or the managers they retain $1 of profit, then over in the future years they need to generate more than 1 year of profit. Okay, so that's a $1 premise, and so we can see whether they did generate more profits from the retained earnings. Then here is the market cap. It's a bit of a a mixed basket of looking at the US dollar and ZAR, depending on the currency and all that. And then the market cap, I put them as super, large, like small, medium, etc. And then the total score, I have a scoring system that I use to try to score, and and then personal gut feel. So and then I look at the technical analysis from the chart, and then decide whether I would include or not. So in 2015, if you look at that, even though Pinnacle is a small cap, I still include it. And I have a weighting of 8%. And so that's and weighting category, if it's 1, that means 10 or more percent or higher weighting. 2 is should be less than 10%. And then that's the PE ratio and the share price and the currency, etc., and the margin of safety. So I was diligent in doing this in previous years, early years. But then afterwards, when I didn't have time, I actually slack on it, and it was actually didn't do what I should do. Okay. Then the next one is the charts. So this is looking at technical analysis, and you can see this is a screenshot from Standard Bank technical analysis. Looking at the chart, looking at generally when I was at that time looking at the technical analysis, I was looking more like big, the big patterns, the major patterns like your head and shoulders, or inverse head and shoulders, like double top and that, and then to see what the trend says. Okay, from the technical screening. And then here's the pivot table I use, and then just looking at the various industries, just to see whether there's a diversification across different industries. So we don't just have everything one industry, and if something goes wrong with that industry, then it can be a big bad knock. So this is the final, after the process, I think this is the final portfolio. Yeah, you can see. So in 2015, at the beginning of 2015, I put together this. You can see AIG, some financial services from the US, AIG, Bank of America, and then Capital and Counties, that's local, but they have offshore exposure. Harmony is gold mining. Impala, Into Properties is property. The Pinnacle is technology. Sberbank is Russia, financial services, trading very cheaply, has always been. But then the Sasso, Toyota is automotive, and Volkswagen, and WBHO. Okay, so that was the portfolio at the time, and I put together all this so that I could use this to track, so that I have this at the beginning of the year, and so that at the end of the year, then I can say, how did it do? The ending price compared to the price at the beginning of the year, and also calculate the dividends received or supposed to be received, and then to say like what's the total return. And here's to look at the exchange rate, because to convert to a single currency, and then this is the trading. And then the lesson I've learned. So I put on here is a lesson I learned from this is from the 2011 portfolio. I spent too little time analyzing stocks due to my lack of time. I didn't analyze stocks properly, and the worst performing stocks, South Ocean down 40%. Yeah, so you can see the problem of, but not everything is going to go well. Yeah, and then here is the some analysis of life insurance companies in South Africa, banks, mining, and the dividends. Yeah, so this is the kind of the process I went through to. Okay, so I just want to then go back to show you where kind of the value 8 I used. Let's just see 2000 and let's put Pick 2006, for example. Let's see if you have there. Okay, that's just yearly. Okay. I think. Okay, so for each company, like I'm using Standard Bank example. Each company I have, I use a spreadsheet as model. So you can see from like 2007 and 2006, etc. I did valuation, and based on the method from the Warren Buffett way. So if you look at this one, this is the initially from 2001, and this is 2002. So if you look at 2002, just to show you what the model looks like. Okay, so you can see this is like the comment sheet, and here's the parameters. So there's certain assumptions that need to be made in order to calculate the present value. The Warren Buffett way, in terms of calculating doing the valuation, you kind of discount the future cash flows, and so these are the kind of parameters I put in terms of most recent annual dividends, interim dividend, then the most recent headline earnings per share, and dividends, when was the dividend paid, and average PE ratio, average dividend payout ratio, broker administration fee, number of shares will be acquired, brokerage fee, and MST is like, I think the straight levies and other acquisition costs, because we want to take into account the cost of trading or like buying the shares, and then to look at how we going to get to the return. All right, and a broker admin fee inflation, there's a certain assumption made about the admin fee inflation, and then here is the required rate of return. So in South Africa, I use a required rate of return of 10%. Okay, then the equity risk premium of 3%. So assuming that the risk premium is 3% above the risk-free rate, then here is the inflation number. So inflation number I kind of projected for the for 5 years, and thereafter I assumed it's just stay at 7.5%. And here is the kind of a standard deviation, I think. Yeah, and then this is the mean in terms of headline earnings per share growth. So at that time, based on the Standard Bank previous years' history, and I was assuming it would be growing a bit faster at 18%, then down to 16%, and kind of start to be closer to inflation at a 14%. All right, so that's the model I built, and then these are the kind of macros in the background, and then you can press this to do the calculation, and then or to go to another sheet, and here is the analysis. So essentially, what the analysis will show is like I will have 3 scenarios. One is kind of a 95th percentile average, and the fifth percentile and lowest, and then to say what is likely to be the result, and then to give a range of possible cases, and then so based on that, and then discount the dividends, the present value of the dividends, and also the projected share price in 10 years' time. Because at that time I was doing in 2002. So I say, okay, if I were to have received the dividends over the next 10 years, and assuming a certain share price in 10 years time, all right, and then discounted back to now, okay, what would be, and using the discount rate of 10%, what would be the value, fundamental value? So based on that, it give you the price to pay. Okay, so about ranging from 29 rand to 36 rand, and how much we should be paying under different scenarios. Okay, so that's that, and then this is a share value using, this is a chart. Okay, lowest to the 95th percentile. Then here is the returns. Just a projection, and then here's the kind of the values using by doing the macro and doing the calculation, and then to see what the value of the EPS, and because of this assumption in terms of the dividend payout ratio, so then that's then will filter down to dividends and the present value, and here is the model. Okay, so that's how I would calculate and get to the share value, get to analysis here, and from here then it compares with the share price at that time to say, given these scenarios, what I think is, can be a very optimistic, or maybe is not so good, then what, how does it compare with the current share price, and is right now is this margin of safety. So Warren Buffett, he focused on the margin of safety, or his mentor. So that's what I do to say, is a margin of safety, and then should that be included? Okay. So if you look at later years, it's going to be similar. So this is 2009. Okay, just enable macros. So if you look at in 2009, I think it's going to be a similar, and in terms of fundamentals. Okay, fundamentals at that time, if you look at it, I've been keeping track. Okay, so I was keeping it year after year, and every year just add another column. Okay, and then from 1994 all the way to 2008 at that time, in terms of the headline earnings, dividends per share, in terms of cumulative dividends calculation, and also like whether it's about the calculation for the $1 premise, and to say that it's actually above one. So it's allocation of capital is good. Okay. Then there's parameters. So you can see there's some refinement over the years in terms of the parameters, but there's it's still using this similar kind of things. Then there's the model analysis, and then then here I think that later on I added to show the margin of safety. Okay, to say whether what's the margin of safety, and then this actually shows the margin of safety of 60 to 80%, which means it's actually at that time very good value to investing. Okay, so that's so that's the model. I think maybe just show you going back. Maybe going to show you the in 2009 kind of my yearly model portfolio, and then you can see so just to show you in 2009. Okay. Previous portfolios, this is the process, macro, the same. Candidates. In terms of candidates, in previous years, you will see that there's more work done in terms of valuation and also margin of safety. So you will see that there's more companies where I did the calculations and show the margin of safety. So some companies got a margin of safety of like 50, 60%, which can be quite large, okay? Yeah, some of these companies still around. Many of them have disappeared. Okay, but margin of safety, I think that at that time I say if it's anything but above 40%, then it's purple. That means a high margin of safety. If anything that's lower than 20% or 30%, then it's low. And if you look at a company like this one, I think it's MTM at that time, according to my valuation, show that margin of safety is negative. Okay, so it shows maybe highly valued at the time. Okay, so yeah, that's and I was putting into different categories, and also for this resource stocks, and then secondary consideration. So it's in the past, sometime I did spend quite a bit of time trying to analyze quite a number of companies, and then from there, then I decide whether it's going to be included or whether it's going to be shortlisted. Then find a short list, then to decide which ones are going to be included in the portfolio. Okay, so that's the process I followed. Okay. Comments, questions?
I think you made it unnecessarily complicated assignment documents.
Okay. No, I think it's just to share with you my methodology, but because now I ask you to, I'm going to.
I mean, I probably won't follow his method. You want me to manage, I probably won't follow you exactly.
Yeah.
Like, also can't guarantee like 20% returns.